Welcome to the deep dive. Ever worry about your retirement savings? Well, today we're looking at something that might be quietly putting them at risk.
hmm
We're diving into how pension funds searching for better returns, this hunt for yield, and how private equity firms operate, specifically with leveraged buyouts, might be creating a potential crisis down the road.
Yeah, it's a complex picture. We've looked at a report that really breaks down the playbook these private equity firms use today.
And we've got some case studies too, right? And we'll look at the government safety net meant to catch failing pensions.
Exactly. The goal is to pull out the key things you really need to grasp about this whole situation.
Okay, so let's unpack the private equity side first. The leverage buyout, the LBO, it sounds technical, but the modern version isn't always about making the company, run better day to day,
Right. It's often more about what's called balance sheet engineering.
which basically means,
Basically, uh, the private equity firm buys a company, but then arranges for the company itself to take on a huge amount of debt. Not the PE firm, the company.
I see. So the debt lands on the company they just bought.
Precisely.
Yeah.
And that changes everything.
Mhm.
Money that could have gone into, say, new equipment or research or critically funding the pension plan.
Now goes to paying off that debt.
That's it. Debt service becomes the priority.
And how do the private equity investors actually make their money then, if the company's loaded with debt?
Well, there are a few ways. One big one is dividend recapitalizations. The PE firm basically tells the company, go borrow more money.
More debt.
Yep. And use that borrowed money to pay a big special dividend directly to the PE firm.
So they're pulling cash out, funded by debt the company has to repay.
Kind of like paying themselves with a credit card taken out in the company's name. Plus, they often charge the company monitoring fees just for overseeing it.
Okay.
And sometimes they do asset stripping, like selling the company's buildings or land and then leasing it back.
Which means the company gets cash up front, but now has a long-term lease payment.
Exactly. Another fixed cost added to the burden.
Okay, so that's how the PE firms operate. But where does all the money for these huge buyouts come from in the first place?
And this is where it gets really, really interesting. Maybe ironic is the word.
How so?
The single biggest source of capital for the private equity industry is pension funds.
Wait, the pension funds are funding these LBOs? The same funds that need companies to be stable to pay pensions.
That's the paradox. Pension funds are under immense pressure to hit high return targets, the numbers their actuaries say they need. Private equity offers the potential for those high returns.
So, to meet their own obligations, they invest in strategies that might actually undermine the security of other pension plans when those PE-owned companies struggle or fail.
It's a kind of self-cannibalization, as the report puts it. One fund's search for yield contributes to the risk for the whole system.
Wow. Okay, so if these heavily indebted companies do fail and the pensions are underfunded, what happens? Isn't there a government backstop?
There is. The Pension Benefit Guaranty Corporation, the PBGC. It's like federal insurance for private defined benefit pensions.
But how well does it handle this kind of risk?
Well, that's the problem. The PBGC is reactive. It steps in after a plan fails. It doesn't have power to, stop a company from taking on too much debt in the first place.
And it's financially sound.
Historically, it's run deficits, sometimes massive ones, tens of billions, and its premiums, the money it charges plans for insurance, aren't really based on how risky the company's finances are.
So well-run companies might be paying similar rates to these highly leveraged ones.
Effectively, yes. The safer plans end up subsidizing the riskier ones.
Which leads to this cliff edge risk the report talks about.
Exactly. The system can handle some companies failing, one here, one there. But if you get an economic downturn, you can see a whole wave of these highly leveraged PE-owned companies going bankrupt around the same time.
Yeah.
Because their debt makes them very vulnerable to slowdowns.
And the total potential shortfall in pensions across the U.S. is big.
Multi-trillion dollars, potentially. If a big wave hit, it could just overwhelm the PPGC.
Requiring a taxpayer bailout, which nobody wants.
Nobody. We've seen warning signs. Look at Toys. Their failure left a $135 million pension hole for the PPGC to fill. Or Sears, its huge $1.5 billion pension plan was pushed right to the brink.
These aren't just random accidents, then.
The report argues they're predictable results of a business model focused on extracting cash quickly, sometimes at the expense of long-term health, including pension funding.
Okay, it sounds pretty bleak. What can actually be done? Are there solutions proposed?
Yeah, the report suggests several regulatory reforms. Things like changing bankruptcy laws so pension claims get higher priority.
Makes sense. What else?
Expanding the legal duty, the fiduciary duty of company directors to explicitly include looking out for pension beneficiaries.
So they can't just focus on shareholders.
Right. Also, making the PE sponsors themselves potentially liable for pension shortfalls, joint and several liability.
That would give them more skin in the game.
Definitely. And finally, making those PBGC premiums actually reflect the real level of risk a company's finances pose.
So really trying to realign the incentives here.
Exactly. Make risk carry its real cost.
So this deep dive really shows how actions in, one corner of high finance, chasing returns, can ripple out and potentially create these huge long-term risks for your retirement security.
It really brings up a fundamental question, doesn't it? When these complex financial strategies are used, shifting risk around, who should ultimately be responsible if things go wrong? Especially if the profits go one way and the losses potentially land on retirees or taxpayers.
A crucial question indeed, something to think about as you look at the bigger financial picture and, well, your own future.